Well, greetings, class. Today we're going to talk to you about record entries and combining records. And we're going to be in part A right now, which is basically a short lecture and showing you basically how these different records meet. And of course, we'll be using the combination of the inventory records, which we already talked about, and income and expenses in this. So first of all, let's look at how official record entry rule that we need to follow anytime we do with the record books, and that is date has to be on any kind of an entry. The date is what is the date and of course a month and the year, and that makes that an official entry in record keeping. And then you need a description of what went on during that, what transaction happened, if it was cash or expense or income of that nature. And then you need to have the amounts, depending on what kind of amounts, either there be taking money away or adding to the balance that you have. And another term you would have on these things would be, of course, income, money's coming into the business, or you would have expenses, which is money going out from the business. So if you look, for example, remember the cartoon we showed you during the inventory, and that was that inventory are assets that you have that have a value to them. And of course this cartoon shows you that with, you know, the cat has the birds in the tree and he has his assets there. That's his inventory. Remember that we told you that the opening inventory is January 1st and the closing is December 31st. And then now we add two more records onto that, which is income records and expense records. Income is money coming in, expense is money going out. And now these are now used together to work your record book, or a combination of your records, or combining your records. So remember that when we say January 1st, we're talking about beginning or opening inventory. When we talk about December 31st, we're talking about the closing or ending inventory. We also, remember we told you that January 1st to December 31st is a fiscal year, or the business year. And or another thing, it's a tax year. And that's the period of time in which the records are kept for tax purposes, business purposes, so you know what went on for each year. Now, when we begin this flow chart, remember we start off with the beginning of the year, January 1st, opening inventory. Remember the opening inventory happens on January 1st, which means that the year before, on the closing date, the last day of the year, December 31st, you bring over, you close that out, and then you bring that over to opening on the next day, which is January 1st. Then keep in mind on 31st is the closing, and that's the current year that you're going to be working with when you deal with record books. The current year is what the year that you're in. So now you have income we bring into play, which income records and expense records that come into play now with your inventory. And all those activities that happen during the current year is marked in those areas, income and expenses. And then, of course, your inventory will change during the course of the year. Either you're taking away or adding to it. And, of course, then at the end of the year, you show a profit. Now, with the income statement, it's basically what it means. It's money flowing into the business or the individual. Most of us think of it as a paycheck coming to us. Expense records are those money going out or flowing out from the business or the individual. And we think of those expenses that we pay, you know, utilities, water, cable, cell phone, those things of that nature. And then we have what is known as capital items. Remember we said capital items are things you keep for more than 1 year. They have assets like vehicles, you know, equipment that you need to run your business, that you have over time that you need. So those are capital items which is worth over $100, and you keep them for over a year. Then you have consumable items. Excuse me. Consumable items, which would be things you use up during the course of the year. But if you have those any consumables left over by the end of the year, December 31st, or remaining consumable goods, they get moved over into the end of the year inventory because you still account for them. They're still worth value to you. You still have money for them, and so you need to have that. Excuse me. So let's review the process. The opening inventory. Okay, so let's review the process. Opening inventory. assets from the last year carried into the new year. Okay, that's your opening inventory. Then you have income. That's money coming in during the course of the year. People paying you, money coming in, right? Then you have the expenses, and that's money going out. Oops. And then you have the ending inventory, which is list all your assets you have at the end of the year. Capital inventory, and also consumable that you did not use during the year. And now that's how the record flow works. And that's the combining of the records that we're talking about, the most important records that we deal with. Okay, so now it's time for a little bit of example time. I'm going to show you some examples how they get put in play. You'll go to the part B of this, and we'll see you in a few minutes. Okay, thanks.